All right, we're live. Hi, everyone. Welcome back to Real Estate IQ, where we're raising your IQ to become a real estate expert. Today, I am with Laura Corley, the fabulous Laura Corley from Cross Country Mortgage. Laura and I have known each other for a long time. We sat back to back in some capacity at a good old days at Berkshire Hathaway, and I guess Trident, right, at that point.
Yeah.
So, Laura, thank you so much for coming on. I really appreciate it. Why don't we do this? Why don't we do a quick minute, just kind of background on your experience, whatever you want to say about yourself, whether personally, professionally, a combination of the two. Let's do that just so the audience gets to know a little bit about you before we jump into some questions.
So I am currently with Cross Country Mortgage, and I came on board in 2021. Prior to that, Trident Mortgage, fabulous local lender, and they did a super job, built some really strong ops that we carried over with us on our team. And before that was another local lender, so not too many jumps in my almost 20 years in the industry, being as I am not that much of a spring chicken. This is my second career. Prior to that, I had a lot of experience kind of coaching and teaching, and I really enjoyed doing that in the mortgage field, especially first-time home buyers, and then people branching out to like investment space or jumbos or second, third home. So that's a piece of my business that I've been kind of practicing for the last 40, 45 years.
Cool. Fun fact. Tell me about your ice skating past. Why not? Let's do it.
Yes. So that was where I came from prior to mortgages, and took a pretty big leap off the ice and into banking. But I started skating when I was about 6, kind of did all the things that you might have seen on TV in terms of training, early hours, late nights, traveling, homeschool. Then I went into coaching, national, international level. So it was a lot of fun. It was just a really unique experience, but have 25 years of, on ice coaching and teaching and skating and leaping and twirling experience. Yeah.
Triple axle, double axle. That's a thing, right?
Yeah, I did do triple axles. I probably didn't hit any clean ones in competition. And but I hung out with all those fancy names. I competed in the Nancy Tanya era, and held my own. Let's just say.
That's really funny. As you were saying that, you know me, I'll deviate very quickly, so I'll keep us long. But I'm trying to think of the context. But I did just tell my kids about the Nancy Tanya like thing and all that. I don't even know how it came up. But I probably told my son.
Batting practice, maybe?
I'm sorry?
Batting practice?
Yeah, exactly. It probably was obviously something about that, but I couldn't remember Tanya's name. I remembered Nancy carried it. So.
Oh, right. Wow. That's usually it's the flip. So
it's the flip.
Yeah.
Oh, right.
Yeah, Tanya. Mm-hmm.
All right, so let's jump into it. We have some questions loaded. We're going to try and keep it to 30 minutes because I know we both have settlements today. Boom, that's fun. Let's go with, let's see, let's talk about what's required from a buyer for a proper pre-approval, right? Because I think most buyers know that they need to be pre-approved. I think a lot of people don't know exactly what that means, but then more specifically, I put the word proper in there because I think there's a little bit of probably a difference there. And you have like some of these old timers who say the pre-approval isn't worth the paper it's printed on. And I don't want to go down that road. We can kind of explain why someone might say that. But let's talk about just like, all right, credit, W-2s, bank statements, what's ideal, what typically happens, and then I think we're going to branch off. I have to look at our list. I think we're going to branch off to common problems that that prevent people from getting pre-approved altogether or prevent them from getting more favorable terms. Like, all right, you're because we have a lot of conversations with people like they're on the threshold. They need to do this. They need to do that. And then we'll tie that into kind of the credit stuff, which seems to come up. So one thing at a time, like proper pre-approval, what's it look like?
Sure. Proper pre-approval is going to be, it's going to start with a good conversation. And there is a application that has to be filled out, which is going to involve your name, birthday, social, so that we can do a soft credit pull down the road. We would do a hard pull when they're in underwriting, but really the first stage, we're doing a very in-depth soft pull. It's different than the old days. It has all the data that is needed to run software, kind of set the stage. And then we talk about income, job history, what type of income is being generated for the purchase, and then savings. So the pre-approval application itself will rest on those three areas: credit, income, and savings. But the conversation, I believe, is part of the proper part, either before or after you gather the nuts and bolts. You can get it through an online application, but without a follow-up or even starting with a good 30 to 45-minute interview, you're missing a lot. So there's the part about income. I would say specifically, people enjoy a different income that what underwriting will qualify for. You've got 1099. In this, I think in this culture, we've got 30 to 35% of any potential home buyer that's got something other than a salary position. They could have a side gig. They could be completely self-employed. They could be contracted with the same sort of employer for years and years, and it feels like it's steady, but when you cross over into an underwriting guideline, it doesn't actually, it's not the same as a W-2 employee. So we want to dig into what are the nuances so that we're qualifying somebody and sending them shopping for a house based on the perspective from underwriting and not just what comes into their bank account. So that's something that would differentiate just a basic app, pushing some buttons, getting a piece of paper that comes as a PDF and saying, I'm good to go, because that's generated solely on the home buyer's perspective.
Right.
And then savings, you either have the money or you don't, but we can also dig into a lot of ways to help buyers with closing cost assistance and programs. So again, without that really personal interaction and that interview, digging into the details, then you are sending a buyer out running around with a piece of paper and getting their hopes up in this market, which is kind of dangerous. And it could be fall short. They're under contract and they can't actually buy the house. So the pre-approval, in my opinion, comes with your basic core data, at least a soft pull on the credit, definitely personal evaluation of the application, and then collecting some basic docs to go along with that. Most people are not going to lie, but once I see bank statements and pay stubs, sometimes I see something that alerts me to dig a little bit more. And once we get that under our belt, then they're out there safely shopping, and it's a successful experience.
So what you're saying is there's a nuance there between what is quote unquote black and white on paper and what the actual real situation is. So you are kind of this intermediary between the buyer who has this profile on paper and then really an underwriter who is going to dig a little deeper and say, well, even though you have all of these things in black and white, the way we interpret that situation could be a little different. So you need to have that conversation with people, which is why, I don't do this with every listing when I get an offer, but I know many listing agents will make a habit to call the loan officer on the pre-approval and say, what process did you do when you issued this pre-approval? Did you do X, Y, and Z? And sometimes I feel like, it's probably the right thing to do. I think we don't always do it. Sometimes it's a function of, you look at somebody's buyer's financial information. You're like, they're blowing it out of the water. It doesn't
Well,
make
you have a
sense.
lot of experience too, so you
Right,
really
or you
can.
just
You have
know who you're
eyes to
working with.
see that. Yeah.
Can you go back to and this is something I get asked, everybody gets asked all the time. What's a soft pull? Like, does that impact your credit score? In today's day and age where credit score is so important.
Mhm.
Give me this soft pull. What is
Yeah.
it?
Soft pull is going to be it's a credit investigation through a system that does not cause a formal inquiry. A formal inquiry would be posted, and the credit bureaus, being TransUnion, Equifax, and Experian, which is what mortgages rely on, they will potentially drop your score when they see formal inquiries. Formal inquiries mean you're out there looking to take a loan on. If you're looking to take on new debt, your credit worthiness could go down. So the score, in my opinion, there's really a lot of unfortunately some inaccuracies. There's how they score you is not really as representative as I'd like to see on a particular buyer. So when you have what they call a hard pull, it initiates a formal inquiry that gets logged in with the bureaus. The bureaus, oh goodness, you're out there trying to get money that you don't have, so you must be in trouble. It doesn't necessarily take into account what kind. It does a little bit. So a formal mortgage inquiry, which is a hard pull, might be worth 2, 3, 5 points as a credit hit. But it's nice to not have anything when you're really in the exploratory stage, and not until you actually take the credit, which means you're in underwriting, about to formalize a loan, do we have to take that next step. The data nowadays, which it didn't used to be, comes through the soft pull pretty much as accurate as it does the hard pull. So in other words, we see any liabilities, balance, monthly payment, payment history, past credit lines that you would have had and paid off. So we see the same data, and give or take 5 points is going to be the same score as a hard pull. So we can write a pre-approval on that and run software, even though we haven't done a formal inquiry that's posted with the bureaus.
So if somebody is, because we have these situations where people are even shopping lenders, quote unquote, at the pre-approval stage. What if there's 5 soft pulls on somebody's history? Does that
So you don't see at all?
you don't see it at all?
No.
Gotcha.
But I do ask people if they're shopping and they've come to me, I ask, is this your first pre-approval experience? No, I went to my bank, last week. And if they did a hard pull, and I would say big banks tend to do that more. I don't know that they have sophisticated software as we have contracted with. So if they do a hard pull, it might be a good idea to go ahead and jump and piggyback on that, because people probably have Googled and read and seen that if you have a certain amount of inquiries within a short period of time on the mortgage runs, then it doesn't continue to hit your credit. And that's true. The exact window varies a little bit, but I usually say, 21 days. If you've had a hard inquiry last week, I might as well just run it. I have it on record. It'll last for 4 months. And I piggybacked on what you already did, so I'm hiding behind that. So again, that's what a conversation does. You're not going to get that from a system. Those little things help people in the long run.
Gotcha. That's helpful. Because I should know. I mean, I kind of knew soft and hard, but I didn't know like some of the specifics of that. All right, so let's get into common problems that prevent people from getting pre-approved altogether, or prevent them from getting more favorable terms. Obviously, credit is going to be one of them. And I'm curious about some of the common credit stuff you see. So, like, what are the biggies where it's just like it's not happening, at least not right now, or if you wait, you could get a better rate, or whatever it is. What do you see most often?
I do. I don't see too many hard stops. I'm more of not a no person, but a not yet if I come across something. So you get past bankruptcy. If you just came out of bankruptcy and, 6 months ago, 18 months ago was discharged, it's a no. I mean, once you get past 2 years, there's some programs that maybe allow you to get a mortgage, but to your point, the terms and conditions are not great. So you're
Gotcha.
limiting your choices. So that's a real hard stop. It used to be that no credit score. But there's some allowances. Again, terms and conditions are not great, but there's some special programs and products. If you don't have a credit score, or if it's a couple and only one does, you can work with that. That's certainly quite challenging. And again, terms and conditions, you're going to get the worst of them and not understand why your neighbor got a rate those 2 points less than you. And then we get into just kind of poor credit. Technically speaking, 500 is a minimum. I can tell you that however a person got a score under 600 is probably going to be more of the problem than the score itself. So you could have a 560. Well, why do you have a 560? Oh, because I didn't pay my mortgage on my current house for the last 2 or 3 months. Okay, well, that's the hard stop, is that
Sure.
you have a mortgage late. The 560 sort of can be worked with if there's some other reasons that might have pulled it down that low. So you find out exactly what the nuances are to be a hard stop, and then you work from there. If it's somebody that had, an extenuating circumstance, a recent event, had severe medical conditions that prevented them from working, that couldn't, all the things, then you build a plan to say, well, making a major move like trying to buy a new house right now is probably not the best idea, but let's look out over the next 12 months and figure out how you can get there. And these are the steps that you need to do. In other words, be on time. Mortgage lates are taken very seriously. Student loan lates are a real killer. Student loan stuff and mortgages are a really tough combination. And that's something I come across a lot, because when a parent co-signs for the kid, I don't know that there's a really great educational experience going along from the student loan creditor saying, you're on the hook. And if your kid doesn't pay, you can't set it, you can set it and forget it. You should actually have backup to the backup on the automatic payments. Because if your 20-year-old isn't managing their bank accounts well, and it goes under, then the payment doesn't get made, and it's your credit as the parent that is hit just as much as the kids. And loan servicing, big deal. They can change, and you go from Navient to Mahila, and the kid doesn't check.
Don't make me start on Mahila.
I could go on for an hour on.
I'm sure. I'm sure.
Yeah. But you get a lot of hurdles. So that goes into what should you do if you got student loans or your kids. Always know your current portal, and honestly, you might as well just add it to your monthly financial review. And these days, and I know because I have young adult children, in the old days, you would sit down maybe once a month or every 2 weeks and pay your bills.
Sure.
And now nobody writes a check. Everything's on automatic payment. I had to explain to one of my children what a monthly statement was for a credit card, because it just comes up on their phone and they push pay. It's done. They don't understand that there's a rollover or, a period, a statement period. So going back to sitting down and really doing a 30-minute review of what's going on with your credit cards, make sure there's no fraud, check in with your student loans, because if they change servicers and they have an old email address, or they claim they mailed it and it gets lost, I can tell you that I have that conversation a handful of times per month, and it can prevent somebody from buying. They think they're ready to go, and they don't realize that something's going on. So that can be either a deterrent or certainly a hurdle in really knowing what your student loan status is. You get things that are in litigation right now, which are these save or pay payment plans or income-based repayment, and
right, income-based,
not on hold, and then they're this and then they're that. Well, mortgages have to count something for a student loan. And physicians, you could have 500,000 in student loans accumulating and no payment required, but mortgages have to count something and earmark something. So again, a conversation is needed, even when you think that you've covered all the bases with what you expect your liabilities to be. And so that goes into, one of the things that could deter you or delay your purchase.
Gotcha. Yeah. So, couple things. Like, I try to be a little bit old school. I'm not a big e-statement guy or email statement, paperless.
Yeah.
I try to still stop getting them. It's just helpful for me. Yeah, it stinks to have a stack of bills, but I at least like don't forget things because invariably, and obviously there's a combination, right? I have stuff that I pay electronically, stuff that comes in the mail, and stuff like that. But it is helpful for it to be tangible and to actually see it. So that's number one. And another thing I wanted to say was backing up a little bit when you were talking about like it's not so much the credit score; it's usually indicative of a different problem. And I was just thinking of like it's a kind of like a medical thing, right? Like the credit is just a symptom. Poor credit is just a symptom of a bigger problem, right? Like you don't pay your bills, or you haven't paid your bills on time. And I just popped in my mind. I wanted to get that out. Let's go to real quick on student loans. So like when I do rentals, and I get an application, I would venture to say whatever 90% of people in a certain age demographic have student loans, right? Sure. Student debt. If you're talking, let's just go first time buyers, right? We're not talking about, move up buyers or people maybe who are a little bit older and established or whatever. If you're just saying like people buying houses under the age of 30, just off the top of your head, how many people have student loans? Like what percentage? I mean,
definitely 80%.
80%. Yeah. That's crazy. Okay. All right. So did we kind of touch on credit issues and how to avoid repair them? I always liked the and I don't know if this may be for people who have no credit, but I always like that thing where you said just get them on a recurring auto payment for Spotify, right? Like, can you give that example? Because I thought that was just like such a good idea.
Yeah. So shout out to one of my kids' friends in college, and I guess my kid was over at their house, and they call out, Miss Corley, and they lay out all of their thoughts about credit. They're trying to build credit. He's 20, and so he's done some research, and he called me, which was good because you see a lot of his stuff out there on Instagram that's doesn't get you from A to B as quickly. So this one hack is good, but it just solves something that I had known, is that when you're, if you're a parent and your kid is 18, put them on as an authorized user on your credit card. They don't have to have the card. Nothing. You keep the card in the drawer, but they're getting the benefit of your history. It's not perfect, but it's a great jump start. Then they can march down and they can get a Capital One with a very low pay, limit of $500. And here's where this helps, because I'm not a believer in living on credit, but you have to learn to use credit as a tool in order to put yourself in a good spot on a mortgage, which is the most expensive thing, and you want the best interest rate. So if you've got your first little credit card and you've got these subscriptions, Netflix, Spotify, whatever, 15, maybe $25, let the credit card pay it and have it on auto pay. And then of course have the payment for the credit card on your bank account auto pay, but you're just cycling through like $25 and it's hitting every month and it's paid every month. And if you have a $500 limit, your usage is very low and it's very conservative. And really 4-month cycles, you're going to see a big difference. When I use this tool, kids go from like no score to low 7s in like 4 to 5 months. And then, they skip through the 6s. They don't have to really think about managing. They don't have to swipe. And then because they're not in the habit of it, they forget, which is really awful. I feel bad for them. I want to teach them to use credit. They swipe it and then they're just not used to it. And then they don't pay the bill. All of a sudden you've got this late payment of like $14.72 when I pull their credit. But to be fair, they need to be responsible enough to know that they have to manage this, because when they pay a mortgage, same sort of thing. So I really like the set it and forget it at a very low limit. Obviously nothing that's going to break the bank, and not getting them in the habit of really using the credit card as a I want to go to Florida with my friends. Let me put it on a credit card and then I'll pay it off. One quick thing on that, it made me think of self-employed buyers, small business owners. They use credit cards for lots of different reasons, but also a good tool because they're getting free stuff at Home Depot if they're using the card, and they get their
Sure.
points and they get whatever, However, what tends to happen is they max it out. So they might have a $20,000 credit card limit, but they're going in buying big stuff, or they're charging equipment, and they run it up to 18 or 19,000 and they pay it off the next month. And so I hear often, well, I pay it off every month. But what happens is what's logged into the bureaus is this yo-yo of high usage. And they're really never getting out of the low sevens. They could be stellar and they're at 718. I'm like, you shouldn't be at 718. So you have to play the game a little bit where you get the limit up to 50,000 and then just keep using your 20. Keep it under.
Interesting.
30% is probably better, but the older you get, the more you can kind of withstand. And if you're a young person, you really want to keep that usage under like 20%. But as you build, you and I could go to like 40 or 50%, and it's still clocking it as responsible use because it's reading all the history of.
Right. That's something I could probably do better. So there's one that I should have. I definitely should have a higher limit on, but I go pretty high on it each month. So that's interesting. So they don't. So even if you pay it every month, they don't technically interpret it as like if you ran it after they paid it and the balance was low, they're still gonna look back and say, well, the other months you're kind of approaching your max.
Yeah, they just again, I think it's a broken system. Sure, I get it that you're trying to make sure that you are evaluating by way of a score the person's credit worthiness, but everybody is personal and has different reasons. So you have to learn the rules and then kind of play with them, because the interest rate discrepancy between somebody who's got 780 versus 725 it could be a quarter of a point on a 30-year fixed, which is irritating and expensive after a while. So
Sure.
knowing some of the things ahead of time helps.
It's for since I got a credit card, I paid my bill every month in full, and I think I don't know what it was. I was maybe working on a property or something, and I ran some interest and didn't pay it off in full, and boom, the next month I got some sort of notification from the credit card company. It was like, hey, we're increasing your credit balance to so and so, and I was like, that is such a sneaky thing to do. Like, you saw that this month I, quote unquote, had trouble paying, which I didn't have a choice. But they're like, you know what, this guy's gonna ring it up. Let's make some more money off him. Let's double his credit balance, which I thought was a really
and that's, you have to operate almost from that perspective, that's really what's going on, and beat them at their own game. Now, to just on that point, if they raise your credit score, credit limit, if they go from 10 to 20, there's no hit to your score.
Right.
Of course, it benefits them.
Sure.
If you call and get it, it's going to hurt your score for a few months until you show the responsibility that you can utilize and not max that out.
Yep. So there's a distinction between them unilaterally doing it versus you requesting it.
Same thing with closing a credit card. They close the credit card on you because you don't use a Sears credit card anymore. It's in the drawer.
Right.
Nothing. If you call and cancel it, then it's a hit. It's a change in behavior that is initiated by the consumer, which is, we don't know what's going on, so we're going to make sure that we it's all jacked up.
It is flawed. All right, I know you have a settlement. Quick current rate environment, where you see things going with Trump and Powell, and if we're going to see a drop. Everyone obviously wants to know that. I've moved on from that, but why don't you give a minute on that, and then I want to make sure all your contact info and all that stuff's in the in post production stuff. But why don't you just tell us where we're at and where you think we're going over the next 6 months?
Yeah. Well, they're due for a breakup. Probably, it's very likely. What I think right now, to your point, you've kind of given up a little bit because we were promised this refi boom. I can tell you in 2023, I'm like, just wait, it's 18 to 24 months out. And these predictions are based on the current landscape. So the current landscape is uncertainty. If I were to say one word,
Right.
you've got the tariffs are the second word because it's producing the uncertainty, maybe uncharted waters. And you have lots of people going back, well, the last time we did this, oh, well, there wasn't one. So everybody's nervous, which is driving the market. And I just want to say that when we say kind of the market, you've got mortgage-backed securities that are traded. So you just think about it as any other stock, or bond really. So you have, you've got uncertainty, which is keeping the rates higher. But then we go historically, they're mid sixes. It's not awful. It's just awful when we were 2s and 3s, maybe 4s for so long, and everybody wants to get back there. So, but I would say that if we get into a culture in Q4 where we've got a little bit more certainty, we've got some rhythm in these tariffs, whether the rhythm is up, down, up, down, up, down, there's still something that's constant and you can expect. And the Fed is supposed to drop the rates in September. I think you'll find maybe a little bit of drop in rates for Q4. And I say drop in like a quarter, maybe a half. So if they're mid sixes, they might go low sixes. You're always going to see you're like 5.99. Always be looking at what kind of points or costs get you there.
Sure.
But at the end of the day, the uncertainty is keeping the rates a little bit higher than we would like to see them, or we were promised that they'd be in the 5s by now. The Fed moving their rate down is not directly tied to the 30-year fixed mortgage. It's like the third cousin. It has an impact. It's going to be the cost of money from bank to bank, where a 30-year mortgage is a longer term, not an overnight type of rate. But I think when you see some stability and some drop in that where money is cheaper, it can trickle down to your 30-year fix, but there also can be some adverse consequences. So the Fed dropping the rate, my phone will blow up. Can I get a lower rate? I go through some explanations. It's not really that. And unfortunately, sometimes them dropping the rate can impact the mortgage rates in the negative, and it can go up. And because it's not the only thing impacting that, and it depends on what the byproduct of Fed dropping the rate is. Yeah.
So we are probably, we're an administration away from really figuring out where the hell we're at. It's probably a little too long term, but fair to say that, like anything, if you're buying real estate because of diamonds, diapers, jobs, whatever all those sayings are, and you're going to ride it out, you'll be okay. You'll have an opportunity to probably refinance at some point, whatever it is. But don't slow up your life if you're a believer in buying real estate. If you're an investor, it's a little bit of a different game. You have to be a little bit more selective, but again, there's always opportunity out there. So that's kind of what I see, and business as usual.
Yeah, absolutely.
All right, you have settlement. What's the best way to reach you?
I love a phone call. And I'm sure you'll post my email and my phone call, but my phone number, but 610-731-4415. I'm local. I'm headed right down the city. I've got to hop on Lincoln Drive, and then I'll go Kelly because I avoid the Schuylkill. And I go to the closings. I really enjoy interacting with the people. We do so much stuff, just through Zoom calls or remote or email, that actually meeting people and being at celebration is one of the joys of this. So. That's
great. Yeah, and I can attest. You come to settlements. You're local, which is huge. It's a whole other conversation we didn't have.
Sure.
And like I say, whenever I do an email introduction, I said you're fantastic, you're knowledgeable, you're patient, and I use you for business, and I use you professionally. So thank you so much.
Hey, I appreciate you having me on. Thanks.
Yeah. So once again, this has been Real Estate IQ. I'm Bryan Capone, Laura Corley, Cross Country Mortgage. We're raising your real estate IQ. Become a real estate expert. Talk to you next time. Thanks, Laura.
Thanks.
I'll see you.